Welcome back to our series on Benjamin Graham's investing style. Today's episode is completely focused on part 2, being bonds, the criteria we should be looking out for, and what standards we need to follow according to Benjamin Graham. Just a few things before starting also. If you enjoy the episode, liking it, subscribing, and hitting the bell to stay notified on all future uploads, including on this series and other series that I plan on doing in the future, would be greatly appreciated. Just like the last episode, here are some timestamps to help you guide yourself through the video. That way, if you come back later, you'll know where things are. Does having something in fixed value mean that it is safe? There is possible risky business with bonds. Don't just assume that bonds are a risk-free security no matter which one you buy. There are a couple of dangers. The first of which is the most important, which is credit risk. Then the second is market risk. So the first of which was the credit risk. Not every bond is financially stable. There's a chance you won't get the face value of your bond back. Bonds are super safe. If it says I can make 10% per year on a bond, I think I should buy it, the unwitting old man says. And the business savvy man would reply that you're buying the debt of a company or government. If they don't have money due to poor financial standing, your bond will become worthless. They can't pay you if they don't have money. The second is market risk. The bond's value may go up or down based on market conditions, such as recessions, politics, interest rates, or other alternative investment choices that people want to put their money into. And this is more important if you need or want to sell before maturity. The interest I get back is fixed, so the investment is fixed too. Well, the bond market, like other investments, is always changing. People will move money into or out of the market based on other factors outside the bond market. The interest is fixed, but the investment as a whole is not. Let's get into the whole point of fixed value and the safety essentials needed. Graham feels like bonds should be your most stable investment. With bonds, you should be looking for as close to 100% safe returns as you can. And clearly, 100% is unrealistic, but we want to get as close to that as possible. Because I love those stable returns. Preventing the loss of capital. If you see a bond that makes you think, is this safe? It almost certainly should be discarded as an option. There's about a 25% chance you won't get the principal back with this bond. The coupons are high. What could go wrong? Well, you would actually lose money if that happened. Your marginally higher coupons aren't actually worth the risk you're taking here. What are the fixed value investments to choose from? The first is the high-grade straight bonds and preferred stocks. Second is high-grade privileged issues. And third is common stocks with privilege, making them high-grade senior issues. Only the finest for Benjamin Graham's suggestion. Sure, there are plenty of other bonds to choose from, but Benjamin Graham only wants to choose between these 3 categories. Waiter, forget the lobster. I want the finest high-grade straight bond that this market will provide. And Graham's opinion on high-grade preferred shares are like this. Preferred stocks should be evaluated similarly to high-grade bonds. But finding high-quality preferred stock that's better than bonds is very difficult. Finding high-quality preferred stock that's better than equally high-quality bonds is like finding a needle in a haystack. Sure, they are out there, but they are hard to find. The next point that he wanted to address was the investment grade of bonds being greater than preferred shares. The order of repayment goes like this. There's the senior secured bonds, the senior unsecured bonds, the guaranteed or insured bonds, the junior or subordinated unsecured bonds, the convertible bonds, preferred stocks, ordinary stocks, and then there's your hopes and prayers. And as you can see with preferred stocks, there's a lot above the preferred stock in terms of priority. So as such, the safety levels of what you're looking for in a preferred stock should be higher than the senior secured bonds for sure. Now we're getting into the 4 principles of fixed value selection. And our 4 principles of selection start with the most important, which is safety is based on ability to make payments, not lien. Number 2 is their ability to make payments should be viewed from a worst case scenario. Third, higher coupons aren't worth less safety. And fourth, select through exclusion of choices, which leads into specific standards afterwards into our next section. The first principle is the ability to pay. Safety is based on ability to make payments. Lien is the right to hold something of value from another person until a debt is paid. With bonds, that means recovering money from a company's assets if they can't pay. This often fails though because 1. There are often delays in receiving compensation. 2. There can be difficulties in asserting legal rights, especially if you are an individual investor. 3. Property values and asset values can shrink when businesses fail. There are often delays in receiving compensation, so the more value and assets that a company has when it fails, usually the longer it takes. And time is money, people, so wasting time means wasting possible compounding with your money. When you have flatline growth, that means there's no compounding, it's just sitting there waiting for something to happen. The next is that there can be difficulties in asserting legal rights, especially if you're an individual investor. In theory, you have the right to sell the property of a failing business as the bondholder, but the reality is that courts make this difficult. Usually it will go into another company as a reorganization before the delayed process happens in court. And if you are lucky enough to get compensation, then it's through a long and difficult delay. Third is most important, which is that property values and asset values can shrink when businesses fail. The priced in and assessed value of property is related to the use, more importantly the lack of use. So for example, a jukebox factory with all of its parts isn't worth much of anything. Chances are good that a business specializing only in jukeboxes would go out of business. And when they go out of business, how are you going to collect payments? From their assets. Their assets make jukeboxes that nobody really wants anymore. You're basically collecting scraps and general parts. Your collection of assets through Lien doesn't really mean much in that case. Basically, you really just want to avoid any issues. Would you rather wear a lot of armor and run through the street without looking first, or look to make sure there's no car coming before crossing? Making sure a company can make payments is critical, and trying to cover up damage is a rash choice with investing. Come at me, car. My company's assets, just like my armor, will protect me. Oh, no, he's dead. Didn't really do much. Oh well. The second principle is to view from the worst case scenario. The industry you invest in affects your protection. Some industries are safer than others, which seems obvious, but see what industries are the least likely to fall with decent upsides or returns. He says lots of companies in this hot new industry are issuing bonds with high returns. What an opportunity! And he says the rising competition for market share is making them want to issue out bonds to gain a competitive edge. Those high returns are likely because they have poor credit ratings. The competition is fierce, and a failure to perform will mean your bond is at a greater risk than other alternatives. No industry is totally depression-proof, and nothing is devoid of risk. The closest thing is probably a U.S. Treasury bond. Being in the utility and food industry means that my bonds are totally safe from downturns. Why worry about profit margins when revenues won't go down? Depression-resistant doesn't mean it wouldn't go down a little bit. Additionally, thinking that all businesses in those industries are safe is just ridiculous. Then there's the merit-based on depression evaluation. Assume that the worst can come before you reach maturity. This 10-year bond looks like it'll give great returns. Let's see how things look at its worst state. 5% profit margin with this company this year, that's not good. During a recession, this company lost about 20% of its revenue. I likely won't reach maturity with this thing if things go bad. I think I'll skip this option. And what if you can't find good bonds? Well, don't think about buying poor ones. The lack of good options should not be an incentive to purchase bad ones. The primary goal of bonds is safety of capital with moderate returns. Why did you pay full price for that apple? It's rotten and disgusting. Well, I need an apple a day to keep the doctors away. This was the best apple I could find at the one market I went to, so I bought it. If you've been enjoying the episode, consider joining Patreon with the link down in the description below. Our third principle is that higher coupons are not worth less safety, and yield sometimes is not proportional to risk. Sometimes visibility matters. Sometimes the yield is not determined based on credit rating and risk, but is instead sometimes based on the popularity of the company and how quickly the bonds can be sold. Did you see this great yielding and safe bond with the boring old company? Cheryl, where do you find this stuff? Basically, Graham believes you should be interested in avoiding risk with bonds, not factoring in risk reward. Maintain the goal of receiving back the principal payment. He gave an example of two $1,000 bonds, one at an annual $20 coupon and $40 coupon, maturing in 10 years. The $20 coupon has been looked at and seems like it has no chance of failure, versus the $40 coupon that has about a 1 in 20 chance of complete failure. In this, he believes the extra $20 is not worth the risk of failure for the return that you would be getting with the higher yielding coupon bond. The chance to lose the $1,000 is not worth the little extra bits of money per year. Our fourth principle is the selection through exclusion process, and to start by looking at the worst that still hit your minimum criteria and then work your way up, because you aren't as likely to see riskier bonds and get tempted into buying them. Whoa, half the time I get incredible returns. How could this possibly go wrong? You can look and think about the higher yielding bonds that fall into the bare minimum safety ratings first and compare them to the lower yield options later. First, we have decent coverage numbers in a safe industry, great coverage numbers in a reasonably safe industry, and fantastic coverage numbers in a risky industry. All these options fit my bare minimum safety criteria. I can now choose based on how I want to spread risk in my portfolio. But what makes bonds safe or risky? Graham has a list of rules to follow for fixed value investments, the bare minimum criteria that we keep talking about. And these will be explained later on in the video. Follow the rules! Haha, I don't know the rules. Surely I won't get in trouble if I don't know anything. What's the difference between two great choices that match all the standards? If you find two choices with similar levels of safety, then go with the higher yield if they really are meeting the similar levels of safety. You shouldn't be shortchanging yourself. You get about a 100% chance to make $100 versus about a 100% chance to make $200. I have to think about this one. Now we're finally into the specific standards of selection to follow for fixed value investment and some of the main factors to look at, with the more important ones being later on in the video. And these are specific standards according to Graham. Use your best judgment on whether you agree or disagree with what he says, and again, this is not me giving investment advice to you. Seek a financial assistant to better help your personal situation. I'm giving an account of what I read in Benjamin Graham's books, and I'm distributing it here on YouTube in my own interpretations. The first of which is size, second is nature and location, third is terms of the issue, fourth is value of property to debt, fifth is record of solvency and payment, and sixth, the most important, earnings to interest requirements, which is the most important by a long shot. The first of which is size, and generally speaking, smaller companies issuing bonds are more risky than others. So conservative investors should stay away from these opportunities. Even well-researched and high success rate investments can fall just because they lack protection of being larger. For our startup lemonade stand business, we're issuing out $1 million in bonds at a 10% interest rate. These kids are crazy. Typically, when we're talking about size, we're referring to the industrial bonds, and Graham's recommendation is to look at the top 6 corporations of whatever industry you're looking at. So you think you can beat me? Well, this is harder than I thought. However, size doesn't guarantee safety, and biggest doesn't mean the safest. Bigger generally means safer, but don't blindly throw money at the biggest in the field. Why bother looking at balance sheets? This is a large corporation. Surely they know what they're doing and are looking out for my best interests. Come on, old man. It's like you're not even trying anymore. And also, the second standard is the nature and location, in which class weakness doesn't mean business weakness. And very simply, there can be opportunities in places normally seen as unstable or low growth. The nature is what the product or service is and how it generates profits for the company, whereas location is everywhere the business operates and has market share. Most of the stuff in this industry is garbage. Why bother looking at anything here? You would just be limiting your options by doing that. Try searching for things after applying a filter for your minimum safety criteria. Our third specific standard is the terms of the issue, and safety shouldn't be cut due to short maturity. Having a close maturity date might normally give feelings of relief for investors, but understand that some companies cannot issue long-term bonds because of their terrible credit ratings. Below I have a list of Moody's, Standard & Poor's ratings and the grade that they have versus the risk that is typically associated with that standard. Wow, this bond matures next year and is being sold at under par value. What a deal! Well, if you actually looked at the balance sheet, you would see that they don't have the cash to pay back the principal. You can only hope to get your money back if they sell their assets, but it looks like they won't have much there either. Fourth point is the value of property to debt, and generally, the bond's integrity and stability comes from its ability to uphold financial obligations through payments. Relying on lien is not the primary form of stability, it's just a bonus here. So relying on regular payments is good, selling for payments is bad. Then we have appraisals. Graham often talked about how disappointed he was in how a company appraised their assets, often going 66% higher in their listing value compared to what it was actually worth. Businesses are just trying to make themselves look better than they are. The difficulty in setting prices gives them wiggle room to swindle investors. So don't blindly believe what a business says their lien is worth. Hey kid, buy this TV, it's as good as new. Let's say $400 for the thing. Yeah, here you go, mister. Surely there's no incentive for you to lie about what this is actually worth. Feel free to take my money. Then we have specialized equipment in terms of value of property to debt. Things can be sold to make money. Who knew? Things like cars, TVs, power tools, oil drills, and so on. However, you should be skeptical when they use equipment to show possible lien payments. Can they really get the payment back that they are listing? Sure, they can sell equipment to make payments, but you need a buyer for everything that you're trying to sell. If they have a bunch of oil drills, who's going to be buying that? Oil companies. But are they really going to be paying full price for used equipment? No, of course not. Also, they know the other company needs to liquidate, so they can bargain for lower prices. Specialized buildings are the same as the specialized equipment that we discussed earlier. The more specialized something is, the harder it is to sell, because you likely won't find many people to buy a bottling factory, a hospital, a research laboratory, and so on. The more specialized, the more difficult it is to sell, and the harder it is to sell, the less likely it is to make a lien payment. Sure, they could demolish the building for just the land underneath. However, that takes time and money. The location is great. You get to get rid of the busted houses all. You can pay full price for this land, right? Well, I'll be paying thousands to get the house demolished, let alone build what I want. There's no way I'm paying full price for that land. Our fifth specific standard is the record of solvency and payments, and what's typically done versus what should be done. The very common practice, which is very bad, is to use the company's dividend payment history to determine its ability to keep making payments for your bond. Because they think if they can do it with dividends, they can do it with my bonds too. Wow, this company has paid dividends for 20 years. I guess I can lock in a 20-year bond with no worries. This whole investing thing is so easy. I must be a genius. And of course, there's Benjamin Graham's suggestion, which is way better than that. Look at the balance sheet and income statement instead. Because past performance does not equal future results. See what's happening now. Management might be over-focusing on dividends and paying things to other people when they shouldn't be. Looks like this company has consistently lost revenue for years. Seems like they have paid dividends for 20 years despite losing so much money. Looking at their plan, I don't think these bonds are going to fund anything that will reverse this downward trend. I think I'll avoid this option and look into other choices. The sixth and most important one is the earnings to interest requirements. And generally, coverage ratio is the most important factor for determining the safety of a bond, and that's because the ability to make payments is key to safety in fixed value investments. Coverage ratio is a metric to evaluate their ability to make payments. Thus, coverage ratio is the most important factor for determining the safety of a bond. So you might be asking, how do I calculate this? What are good numbers? An earnings coverage ratio can be put into two phases. The first is how do you calculate the numbers, and the minimum acceptable coverage numbers. So the first of those two questions is how do you calculate the numbers? First of one of the two options is the cumulative deductions method, where both the junior and senior bonds are combined and compared. So for example, this company has $1 million in yearly earnings. It has two bonds, the senior at $250,000 yearly interest and the junior at $300,000 yearly interest. The first issue calculation goes like this. 4.0 coverage ratio for the senior bonds because you take the yearly earnings and divide it by the yearly interest of just the senior bonds. And the second issue calculation goes like this: the $1 million divided by $550,000, because now you're combining both the yearly interest from the junior and senior bonds together. And that will give you the 1.82 coverage ratio for the junior bonds as compared to the 4.0 coverage ratio of the senior bonds. Then there's the total deductions or overall method, and this is a much more conservative approach and Graham's favorite choice in evaluations and what he uses for his minimum criteria evaluation numbers that we'll get into later. His idea is that all bonds, regardless of tiers, are dependent on each other, since low tiers failing likely means that the business is also failing. So using the same example as the last slide, this means both senior and junior issues are at 1.82 coverage ratios. That's how to calculate the numbers, but what are the minimum acceptable coverage numbers that we should be looking at? These are the numbers that Graham felt were minimum, the absolute bare minimum for earnings coverage numbers. And this is back when he wrote this, so use your best judgment to see if this still applies to this day. And obviously more coverage is better than less coverage. So you want to adjust to a larger coverage based on the risk of the industry that you're looking at and seeing it in its worst state. For bonds versus preferred, public utilities, the minimum number would be 1.75 versus the preferred being at 2. For railroads and bonds, it'd be 2. For railroads and preferred, it'd be 2.5. For industrials, for bonds, the minimum would be 3. And for preferred, the minimum would be 4. Looking at our previous example at 1.82, the only one that passes would be bonds with public utilities. So anything that is not a bond with a public utility with those numbers that we saw previously would just be outright excluded and not looked at any further. Do you like Benjamin Graham's style? If you like his style of investing, then you should get his books from the description down below. Those are the books that I read to make this video. And his books will give diagrams and charts to help you learn the topic of bonds even further. And his writing is very technical and great for learning, so I highly suggest it. And did you enjoy the video? Did you learn something new or think about investing in a new way? If so, smash the like button to show you enjoy these types of videos, and subscribe and hit the bell if you're new here. These types of videos take a long time to make, so it's greatly appreciated. And thank you so much for watching, and I hope to see you in the next episode.